Hi guys, how are you? I hope everyone is doing good and you guys are keeping safe at home. I know we have challenges about how we conduct classes lately, but to be honest, this is all what we are trying to do as lecturers, as academics, to try and support you in your learning journey, because we know that the pandemic that we are currently facing is something that was not planned for or called for. So please bear with us in this period. I also hope that things go back to normal so that you can come back to school. But for now, we are going to use this platform to communicate and to also support you in terms of your activities so that you don't forget what you learned, and we keep that learning spirit going until we have amicable solution or a permanent solution. Now, last week I gave you a task. I said to you, please do activity 4.1, 4.2, 4.3. So in this video, I'm quickly going to explain the definitions, the concepts that you need to do before you start with the activities. I think one of the activities that I gave you, the assignment that I gave you, actually gave you some sort of an idea in terms of what you need to know going forward in terms of this learning unit. So those concepts that I said you must define and give example are very crucial for this learning unit, because we are going to focus on those concepts right through the chapter. So bear with us. So without any waste of time, let me start by explaining all the concepts we have. And for those who don't know me, for those who never come to my class, for those who are seeing me for the first time, for those who are in the other groups that I'm supporting, let me formally introduce myself. My name is Kenneth Mahodielo. I'm the lecturer for Accounting, DHP, and DCMM. So yes, without any waste of time, let's get into the business of the day. Okay guys, the session is about to start. So this learning unit is called recording the transaction. Basically, it's all about recording different transactions into different journals. That's all that you need to know, but there is a way of knowing. So where there's a way of learning that we use as well. We are using a method called learning from the known to the unknown, meaning that whatever that we did from chapter 1, chapter 2, chapter 3, you must still have it. That is your concrete foundation going forward. So when we learn learning unit 2, you will see we are still going to apply some of the things that we did from learning unit 1, 2, and 3. So ensure that you are on track with that one. So without waste of time, let's start. Recording transactions. Obviously, this was compiled by me. Going forward, the learning unit outcome, we want you as a student to achieve the following. We want you to ensure that you know the main purpose of a business. You know the reason why we have people going into business, or while we have entrepreneurs. The second point, you must be able to define different journals. So you must be able to know why we use all types of journals that we have. Currently, we have 8 journals. You must know all of them. Why do we use them? They are used for different purposes, but it's a very easy thing to know. Then the third one, you must be able to post on journals and general ledger. So these journals that you must know, you must also be able to post on them. It's no use for you to know that the journal, but you cannot even do or post transactions of those journals. So here, this is now us taking you to through the accounting cycle, which is transaction. We want you to be able to post these transactions into different journals and also into a general ledger. The last one, you must be able to list ledger accounts on a trial balance. Very simple, guys. You must be able to list all your ledger accounts onto trial balance. Remember, this is the accounting cycle. We are preparing you to know how to record or to know how to do uh, your statements, your financial statements. But first, you must know first how to record a transaction, how to take the same transactions and post them on a trial balance. Now, the main purpose of a business, we all know why people are going into business. The main purpose of a business is to make profit. For any business, there's no one going into a business with the mindset of not making profit. We all get into a business to ensure that we make profit. But not only profit, we also want to increase our wealth, which is your owner's equity. People go into business to create wealth for their families. For example, you look at famous people in our country that have been able to do that. You look at your Oppenheimers, you look at your Ruperts. Yes, they are making profit, but they are making more than profit, which is wealth. They are creating wealth. Sometimes it's a generational wealth, meaning that it's a wealth that can be passed from generations to generation. It will still be there. So people want to create legacy through creating wealth, through starting up their own businesses. Now, here we say that the profitability of a business should also be monitored, which is something that people don't really, pay attention to. Last time I told you that one of my client, that lady who whose business was operating for 2 years without making any profits, but because he didn't have accounting system that he was using, she was not able to see that his business or her business was not making profit, but was operating for more than 3 years. But when I came in and I did her books for at least a period of 1 year, I was able to notice that she hasn't made any profit at all. So this is what we're talking about. You must ensure that on a regular basis that you check how profitable is your business. Sometimes it only means that if you are selling some of the items that are not making money for you, you need to stop selling them. You must focus on products, on items that generates income for the business. Like other items are seasonal. Take example Makam. You cannot Makam cannot sell jerseys and coats during summer because it's too hot. No one is going to wear a coat. But when it's winter, Makam cannot be selling vests and t-shirts. People want jerseys now and coats. So they need to have that mentality to say when it's June, they need to focus on warm clothes. When it's summer, they need to focus on summer clothes. So we are also saying that monitoring of cash movements to and from enterprise is equally important. Now, what we mean by that is that as a business, you need to have sufficient cash flow coming in and out of the business in order for you to remain sustainable. Now, what other people are not aware of, I always say that the accounting profit that you see when you do your books, it's not actually money. That's why I call it accounting profit. That's where you have the difference between financial accounting and management accounting, where management accounting they will only recognize profit if the money is in the bank, but the financial accountant will recognize profit even if the money is not yet in the bank but in the hands of your customers or your debtors, because you are expecting them to pay that money within certain period of time. So we also say that it's very important to ensure that you have enough cash flow in the business, because sometimes what people don't see is that if the money that you think is in the business but it's in the hands of customers, then there's still a lot of risk to it, because you need to collect it first before you can realize it as profit. So you must be able that you maintain that formula, that it must always be sustainable for you to have enough money. Don't give too much credit to people, because there's also a risk that they might not pay back. For example, let's look at this pandemic. How many people are going to pay back their debts? Not a lot of people, because people are going to be unemployed. So same with having enough money. Imagine how many businesses they thought they are making profit because they gave so much credit to people. Now people are not going to be able to pay them. They are going to be blacklisted and they are going to be unemployed. All other things that will happen in the economy is going to affect that business. So, but a business that has been managing their finances well, that they have been making sure that they don't give too much credit, and they also sell on cash, they will be able to, to come out of this pandemic much more stronger. But those ones who gave too much credit because they expected so much money to come in, they might even need to increase their impairment books because of this. So we also say that businesses are supposed to ensure that they have adequate cash flow to avoid liquidity traps, bankruptcy, and solvency. Like I was saying, if you don't have enough cash in your business, next time you're also going to struggle to pay the people that you owe as a business. And once you cannot pay them, those people by law, they can take you to court to say that they want their money back. And the court, what will they do? They will discredit your business, they will close it down, they will file for what we call business rescue, and you'll have to close down the shop. So we don't want that as entrepreneurs. Now, next slide, journals. As mentioned before, transactions are entered onto source documents, which in turn are summarized in journals. For the manual accounting system, we use 8 journals. Like I was saying, we have 8 journals. These are all manual systems that we have in the current generation. In the current years, we have accounting softwares that can do all of this. But even you as a bookkeeper, you need to keep your own records so that if there's a mistake on the system, you are able to pick it up. So we cannot rely 100% on the accounting softwares that we have, like your Pastel, your Sage. You also need to have the manual accounting systems. We go to our last slide. So our last slide, it's on the 8 types of journals that we have. So the first journal that we have the cash book receipt, which is called the cash receipt journal. Cash book receipt, we call it cash receipt journal. Now in this journal, we only record the receipts. We only record all the items that potentially will increase our bank account, nothing else. Now the source documents that we normally use with this cash book, with this cash receipts journal, we have your duplicate cash slips, we have your cash register roll, we have your receipt, your deposit slip. All the money, all the asset that comes into the business, we are going to record it under the cash receipt journal. Now the second one, we have the cash payment journal. Now all the payments that we make, all the payments that we're going to make, we're going to record them on the cash payment journal. These are all the payments that are going to come out of the business and that have the potential of decreasing our bank account. And the source documents that we normally use, we have the EFT confirmation slip, we have the check counterfoil, we have the invoice, we have the cash slips. Third one, we have what we call petty cash journal. Now, petty cash journal, remember what I said, what was a petty cash? Petty cash, we said it's small amount of money that we keep in the business that we use to also buy small items that we might need, being your water, being your food for meetings, being your small items that we might need. We will use the petty cash journal. Now, the source document for petty cash journal, it's a petty cash voucher. Now, if you can look, the abbreviation for that one is called PCJ, so it's petty cash journal. The first one, the abbreviation should actually be CRJ, the cash receipt journal. The second one, CPJ, the cash payment journal. Now we have creditors journal. Now creditors journal, we use it in a situation whereby business, they buy from a supplier, but they buy on credit instead. You are not buying on cash, we will use a creditors journal, which is also called CJ. Creditors allowance journal. Creditors allowance journal, we use it in a case whereby if you buy inventory from a supplier, then you are not happy with the inventory because the inventory was then damaged. You are entitled to return that inventory because you are not happy with it. So we will use what you call the CAJ or the creditors creditors allowance journal. And the source document for that we have the original credit note. For CAJ, for creditors journal, we have the credit invoice. Now we also have debtors journal. Debtors journal works the opposite of creditors journal. In this case, this is when a customer buys from the business and they buy on credit. It's different from them buying on cash. So we will use what we call debtors journal to record that transaction. So a source document that we'll use in that case is a duplicate credit invoice. Do you know why we use a duplicate credit invoice? We use a duplicate credit invoice because this person did not buy on cash. He still owes us. So the original credit invoice will give it to the customer. The duplicate credit invoice will be the one that is remaining in the business. Now, if they are not happy with the items that they bought, they are also entitled to return them to the store. And when they return them, we use what we call debtors allowance journal. Now, debtors allowance journal, it allows customers to return the goods that they are not happy with. And when they return them for source documents, we'll use a duplicate credit note because the original credit note remains with the customer. Now, because when you buy, for example, let's look at the creditors journal and the debtors journal. Creditors journal, we use the original credit invoice. Why? Because now you are the customer to that supplier. But in case of a debtor, we use a duplicate credit invoice. Why? Because that customer is now, or that person is now a customer to the business, hence we have this. Now, the last one, we have what we call the general journal. So with general journal, this is the journal that we use in a case whereby we have transactions that we cannot classify into any other journal that we have. Then we will have what we call them sundry transaction. So these are transactions that we are not being able to allocate to cash receipt or cash payments or petty cash. They are outside the scope of these journals. Then we will classify them as general journal and we call those transactions sundry transactions. And for that, we use what we call a journal voucher as our source document. Now, I'm sure someone out there is asking themselves, what is this source document? Source document, it is a proof of purchase, a proof of payment, a proof of a receipt. It is a proof that when auditors come, when someone wants to know, hey, where did you buy that milk? You are able to show them the receipt, the cash receipt, to say that I bought this at Pick n Pay, I bought this at Mr. Price. So that is all for this video. I hope you learned a lot about these journals. You will get to see exactly how do we record the transaction in the next video. So please stay tuned. I'm going to upload the next video just right after this one. So what I want from you is to also like this channel. This channel, guys, I created for you, the accounting people who are eager to learn accounting. So please make sure that you subscribe and you like this video, and please leave any comments that you might have that you would like me to address. This YouTube video is for you guys, strictly for you. So please, I would like you, most of my students, to please subscribe so that you don't miss out. I will try by all means that even when we are opened officially, I will do these videos so that you can always have a platform to go back and revise and refresh with when you prepare for exam or your test. So on that note, see you next time.